What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. Perhaps the biggest technology story so far this year is Elon Musk's proposed buyout of Twitter. His main goal was to change the platform's content moderation policies and increase free speech. Musk submitted what he called his best and final offer of $54.20 per share, valuing the company at $44 billion. In late April, Twitter's board of directors accepted the deal. With a $200 billion net worth, Musk is the richest man in the world and has more than enough money to fund the acquisition. Also, he said that the acquisition had nothing to do with the economics and was purely because he wants to reform their policies and promote free speech. The buyout came as a huge relief for many Twitter shareholders who had previously been frustrated by the social media platform's inconsistent results and stagnant share price. The acquisition price of $54.20 represents a 40% premium over the trading price before Musk got involved. It looked like a win-win situation. Twitter shareholders would make a quick buck, while Musk could add Techno King of Twitter to his long list of titles. In the weeks following the acceptance, Twitter's share price has fallen by 26%, wiping out all of the gains since Musk got involved. The share price of $38 per share is a full 30% below the $54.20 that both parties agreed to. This is highly unusual. When a company accepts an all-cash buyout offer, the share price usually stays stable at a slight discount to the deal price until closing. So why is this not the case with Twitter? A few weeks after making the offer, Musk put the Twitter deal on hold pending an investigation into the number of fake accounts on the platform. Fake and spam accounts have long been a problem for the platform, with scammers using bots to promote various crypto and other scams. Most social media platforms have similar problems, including YouTube comment sections. Recently, Twitter said that it estimated fake and spam accounts to be less than 5% of its monetizable daily active users. In a recent interview, Musk said that he estimates the actual number of bots to be at least 20%, and maybe even as much as 90%. Obviously, if the majority of users are fake, the company would be worth much less than the $44 billion that he agreed to pay. So what does this all mean? Musk said that the acquisition had nothing to do with economics and is purely for the promotion of free speech. So why is he so concerned about the number of fake accounts? Twitter generates the substantial majority of its revenue from brand advertising. Brands pay Twitter to show images and videos promoting their products. In most cases, the brand has no way of directly measuring the impact of their Twitter ad campaigns. There is no way to directly link sales with Twitter ads, but there is clearly a benefit to the brand if millions of consumers learn about their product on Twitter. Twitter currently says that they have 229 million monetizable daily active users. If it turns out that half of these users are fake, advertisers will be far less willing to pay for Twitter ad campaigns. So clearly, the number of fake accounts on the platform will have a huge impact on the company's valuation. In their most recent 10-K filing, Twitter claims that fake accounts make up less than 5% of the monetizable daily active users. Importantly, they caveat this by saying they applied significant judgment in their assumptions, so the actual number of fake accounts could be higher than their estimates. So far, they have refused to publicly disclose their method for calculating their 5% number. They say that this would require disclosing sensitive information, which they cannot do for privacy or other reasons. To come up with his own estimate, Musk conducted his own test. He randomly sampled 100 followers of the @Twitter official page, and found a number of fake accounts far higher than 5%. However, this is not a statistically rigorous test for a variety of reasons. Firstly, a bot account may follow many hundreds of accounts to make itself appear more legitimate. A real human may only follow a few dozen close friends. So even if only 5% of the accounts are fake, the number of fake followers may be greater. Parag Agarwal further explains that many accounts that look fake on the surface are actually real. For example, some real people may have no profile picture or post odd tweets, making it look like a bot to a casual observer. Internally, Twitter could see that this account tweeted at a regular cadence from the same IP address at regular times of the day. This suggests that it was a real person. On the other hand, if it's tweeting from a bunch of different IP addresses around the world at irregular times in the middle of the night, there's a pretty good chance that it's a bot. There's a careful balancing act between kicking the bots off the platform while at the same time not accidentally shutting down the accounts of real users. The professional spammers constantly innovate and come up with creative ways to fly under the radar. This makes it almost impossible to completely get rid of them. While Musk's sample of 100 Twitter accounts is considered by most experts to be not scientifically rigorous, there have been some more sophisticated attempts by outside organizations. A 2017 study from the University of Southern California estimated that 15% of Twitter users are bots. But outside observers have no way of knowing what Twitter classifies as monetizable daily active users, which is the relevant number for the 5% statistic. So by construction, it's almost impossible for an external study to debunk Twitter's claims. To Twitter's credit, they have increased their efforts to crack down on bots in recent years. In 2018, they launched a huge campaign shutting down 70 million suspicious accounts right off the bat. But if you're a regular Twitter user, you'll see that there's still a lot of work left to be done on this front. If Musk remains unconvinced about the number of fake users, is there any way that he can back out? After all, he's already signed a contract with the company and called the $54.20 buyout price his final offer. The stock market is discounting a significant probability of the deal falling through, with the share price now 30% below the agreed upon price. Large transactions like this require significant legal and advisory fees, and are a major time commitment to the senior management teams, which distract them from other priorities. If the buyer pulls out at the last minute, all of this goes to waste. Because of this, companies selling themselves generally formulate airtight contracts to make sure that the deal gets done, and Twitter was no exception. In the agreement that Musk signed to acquire Twitter, he explicitly waived his rights to due diligence and can only back out of the deal under very specific circumstances. He has to show that Twitter's claim of less than 5% of monetizable daily active users being bots was a misrepresentation and that it had a material adverse effect on Twitter's value. This is a very high bar to prove in court. If Musk backs out of the deal without proving material adverse effects, he would be liable to pay a $1 billion breakup fee. While $1 billion is a large sum in absolute terms, it is less than 3% of the deal value and less than 1% of his net worth. But walking away from the deal isn't quite as simple as paying the $1 billion fee. Twitter would have the right to demand the $1 billion, but they don't have to. They could take Musk to court and compel him to complete the merger. Musk signed a binding agreement, and without a material adverse effect, he is obligated to buy the company for $44 billion. Given that the deal price is $14 billion higher than the company's current market value, it seems very unlikely that they would accept the $1 billion fee. While it's difficult to predict how the potential legal case would play out, prior precedent tends to favor the seller. In November of 2019, the French luxury conglomerate LVMH signed a definitive agreement to acquire jewelry company Tiffany for $16.6 billion. Before the deal closed, the pandemic hit. Tiffany's stores were shut down and their sales plummeted. LVMH tried to pull out of the deal, saying that the pandemic constituted a material adverse effect on Tiffany. Tiffany then sued LVMH, saying that the French conglomerate was obligated to acquire them according to their definitive agreement. After months of the two companies' lawyers wrangling against each other, they finally came to an out-of-court settlement. In light of this once-in-a-century pandemic, Tiffany agreed to decrease the acquisition price by a grand total of 3%. After considering all the legal fees, LVMH barely broke even on this negotiation. If anything, Musk's case is weaker than LVMH's. Twitter's problem with bots has been well known and covered by the media for many years. The filing, which claimed bots were less than 5% of active users, was released before he made the bid. Musk's sudden objection to the deal was based purely on public information available before he signed the agreement. It also doesn't help that he formally waived his rights to post-deal due diligence. Musk said that economics has nothing to do with his Twitter buyout. And being the world's richest man, he has more than enough money to pay the $44 billion if he really wanted to. So why is he now trying to pull out? The vast majority of his wealth resides in his 21% stake in Tesla, which is valued at $140 billion. It is estimated that he has used $88 billion, or more than half of his stake as collateral to take out margin loans. He uses the margin loans to fund his personal expenditures as well as his other ventures. So while he is technically worth about $200 billion, he doesn't just have this sitting around as cash. If he tried to borrow the entire Twitter buyout by borrowing against his Tesla stake, this would put him in a very vulnerable position. If Tesla's stock price continued to fall, he could get a margin call, and his creditors would forcibly liquidate his position at the lows. To avoid this, Musk lined up $7 billion of financing from other investors, including billionaire Oracle founder Larry Ellison, a Saudi prince, a Qatar sovereign wealth fund, and a few others. He convinced these investors to come on board by proposing a new business plan to 5x Twitter's revenue over the next 5 years, by diversifying it beyond advertising. This includes making corporations and governments pay a fee to use the platform. He also wants to expand Twitter's functionality to include a mobile payment function similar to the popular WeChat app in China. While these plans might have merit, it's an uncertain proposition to say the least. He will fuel this growth by implementing extreme work ethic expectations for Twitter's employees. although he assures them that it will be far less than he demands of himself. In the weeks after Musk signed the agreement, social media stocks have tanked. Snapchat, which is one of the most comparable companies to Twitter, declined by 40% since the Twitter deal was signed. The $54.20 buyout was a 40% premium to Twitter's share price before the Musk stake was revealed. But it's probably an 80% premium to where shares would be trading had Musk not got involved. A significant portion of the Twitter buyout will be funded by debt. With the Fed raising rates, financing costs have soared. The higher interest expense will decrease the expected gains for the investors. And finally, Tesla's share price has been tanking, both because of the general market sell-off and because people fear that Musk will divert attention away from the car company to focus on Twitter. This makes it riskier for Musk to take out more margin loans against his Twitter stake, and makes it all the more important to bring on other investors. If the other investors bail, Musk still has the means to pay the entire $44 billion on his own. In a worst-case scenario, a court would compel him to complete the transaction, and he'd be forced to dump almost 1/3 of his Tesla stake at the lows. The walls are closing in, and he's likely using the bot issue as a negotiating tactic to pressure Twitter's board to accept a lower price. Musk's options aren't really that great. Twitter has the most negotiating leverage in this case, so he's unlikely to get a significant price cut. If he does manage to pull out of the deal, probably the best outcome is he pays $1 billion of breakup fee. To make matters worse, he is still under scrutiny from the SEC related to his 2018 funding secured tweet. If he pulls out of the deal and it looks like he never intended to buy the company in the first place, this could be viewed as market manipulation and the SEC investigations will escalate further. Even if he could avoid criminal liability, his reputation would take a large blow and it would be very difficult for himself or Tesla to make any acquisitions in the future. For these reasons, it looks like Musk's bot criticisms are a negotiating tactic to bring down the price. And to some extent, it looks like it's already working, with the share price down 26% from the highs. With the stock now at $38, it's possible that the board will cave and accept a price lower than $54 but higher than $38. But this is by no means a sure bet. Alright guys, that wraps it up for this video. Do you think Musk will follow through with his Twitter buyout? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.